Today is April 26th. This is a new concept from the Resilient Advisor podcast that we are calling Forecast Free Friday. The goal is to help you build a more informed portfolio by talking about current events through the lens of history, math, and behavioral science. My name is Jay Coulter, and my partner in this venture is Clint Sorenson, who's the Chief Investment Officer at WealthShield. Our plan is to keep this content under 5 minutes per episode, no fluff, no ads, so let's get to it. Clint, what is on your radar this week?
Yeah, so it's one phrase, Jay. It's negative divergence, right? So, and what that means is that the market's not agreeing, right? What we're seeing is not necessarily agreeing with market prices. And so that really centers on three things that we're seeing. The first that I'll mention is the bond market is not believing what the stock market is believing, right? So the stock market's running up, and you would think, wow, we're back at all-time highs. But the bond market yields continue to drop. I mean, the 10-year yield's at 2.5%. That's down from 3.25%. So the bond market's saying growth's slowing, but the stock market's saying everything's fine. So that divergence is one of the concerning divergences we're seeing.
Let's look at that from a historical perspective. When have you seen that before, and what were the outcomes?
Yeah, so if you look at that, there's several times. The most notable would probably be, or most recent would be the 2015 to 16 timeframe. So if you look at during that, we had this global contraction, very similar to what we're having now from an economic standpoint. And you had oil drop off first, you had this big correction, then you had the market run up, if you remember. And actually the NASDAQ 100 broke to new highs. The S&P didn't get back to old highs, really close to it, about 2% below. But the NASDAQ actually broke to new highs. Bond yields didn't believe that. And what we had was a retest. And so I think you see that commonly in history is that these V-shaped recoveries are not common. It's typically a W, if you want to borrow a letter analogy, right, where you get this retest and even break slightly below, like the 2015 to 16. And so that's why this divergence is so notable in our opinion.
Okay, excellent. What else is on your mind?
Yeah, so the second thing would be lumber. So Pension Partners, I don't know if you're familiar with them, but great group. They wrote a paper, an award-winning paper on the LumberGold Ratio and how it forecasts volatility. It's really a leading indicator, that ratio, that relationship. And it makes sense, right? Lumber has everything to do with consumption because housing's such a large part of consumption, and the U.S. economy is over 70% consumption driven. So it makes sense from a fundamental standpoint. And then gold's kind of, hey, everything's not going well. I need to store my money, right, in this barbaric relic, to borrow a terrible term. But that's kind of that ratio. That ratio has a lot to do with just risk on, risk off behavior and appetite behaviorally. And so what we're seeing now is lumber led last year. Lumber actually peaked prior to the market, and it bottomed prior to the market. It bottomed in October. Market bottomed in December, right? And so when you're seeing this leading relationship, well, lumber has rallied, and then it peaked out a couple months ago. So it actually peaked out in February. And so now you've got lumber rolling over and now retesting the lows of what we saw in 2018. And that is a clear divergence that has us concerned.
Yeah, I had Charlie from Pension Partners on the podcast a couple years ago. They really do put out high quality research. Yeah,
they do. They're a great group.
What else is on your mind?
Yeah, so the third thing would be small caps, right? So you would expect, and we look at everything from a cycle perspective, right? So you have really four phases of the cycle. You have an early acceleration, late cycle kind of growth trend or acceleration. You have a late cycle slowdown, then you have a contraction, right? Those are the four phases of a business cycle. Well, what you realize is if that the market's kind of saying, hey, we turned the corner and we're running, but that's not typically led by large caps. If we're in an early cycle acceleration, like the contraction we got was just the fourth quarter into the first quarter, then or the slowdown, if you will, then what you would expect is small caps to lead the way out. Well, they're actually relative to large caps below the December lows of 18. So that's actually another indicator saying, hey, we might have a retest. And that also continues to add credence to our argument that we're in a above trend growth, but a slowdown economically.
All right, so the title of this series is Forecast Free Friday. We're going to keep forecasts out of it, but there are implications to this information. What should investors be looking at as it relates to portfolio changes given this?
Yeah, so I think investors have to kind of pull back or throttle, right, the FOMO, right? Throttle that fear of missing out, right? They might have been in a more defensive posture. They've seen growth really run. They've seen great returns year to date, right? Instead of wanting to push the pedal here and force additional risk into the portfolio, I would sit back and just revisit your overall allocation and make sure that it's on par with the goals of that investor. Because right now it's easy to get euphoric, right? Because you look back and that recency bias says everything's okay. But with these divergences present, I think you have to have good risk management, good systems, and a good process in place. So stay the course. I hate to say it any more simply than that, but stay the course, stick to the goals, and don't let the FOMO trick you to do something you don't want to do.
Yeah, FOMO, recency bias, and there's also risk creep for an advisor that has a large book of business. The bottom half of their book could be out of alignment.
That's right. So for an advisor, it's an opportune time to actually be proactive, reach out to their clients, discuss how that client may have creeped on their risk and why now's maybe a good time to position them back to their target. That right there could even add to even referrals for that advisor. Being proactive, getting ahead of this, I think would resonate with a lot of clients out there.
Excellent. Clint, I'm really looking forward to doing this series with you. Thanks for coming on. It's a lot of fun.
Thank you, Jay.